Okay.
We got kicked out.
Yeah, I'm playing around with it. Press the wrong button. There he is. Live stream. Here we go. With Facebook. William there.
Yes, sir. I'm back.
Sorry about that. Clicked the wrong button. Uh,
What size boats did you work on up to?
65 foot. We
Mm-hmm.
could pick up a 65 footer houseboat, bottom job, stuff like that. You know,
Mm-hmm.
anything need to do. A lot of bottom paints and
Mm-hmm.
fiberglass repair. That's nasty, hard work, hard way to make a living.
Yeah.
We're in a small town too. It's love this little town. We got national forest, we got the river, so there's not going to be a lot of expansion. So we're going to be kind of laid back. Uh, But being as there's a lot of retirees here, which means they're
Mm-hmm.
going to be very conservative with the money, and then there's a lot of moldy money up here. You ever heard that term? Yes, sir.
All right. Thanks for joining us today. I'm Major Hilliard. I'm the international best-selling author, also the founder of MH Estates Capital Partners. Today, we're going to be going over a little bit more as what we discussed on Tuesday and how we change communities through our investments, as well as take some questions from a lot of the attending parties and some others that we've had in chat before. But yeah, as we talked on Tuesday, we really know that we bring intrinsic value to our investors, not only for profit, but also we change the lives of thousands of peoples and those who live in our communities. And we're very proud of what we do. So real quick, this is kind of a highlight of last week of the last one on Tuesday. If you missed it, these two pictures right here are the same exact park. We purchased this mobile home park, and then it was only 46% occupied, 46 homes out of 125 pads. Here's the finished product, just less than 3 years later, 95% occupied. Actually has a cell tower on it. We're under contract to sell it, and the profitability is huge because we're able to take these undervalued assets that are delinquent and deferred maintenance, deferred management, fill them up quickly and give a really good livelihood that these tenants have never had before and are so appreciative. And what's so great about it is that we're able to get rents to market rates and no one really complains other than the bad apples, which you get rid of anyway. No one complains. They're very happy because they see that they're not only that, their property values increase. So their homes become way more profitable because the park is more desired and people want to move in there. So a kind of a highlight of what we offer right now with our fund is that we have a 9% pref, which is a 9% return annually, but we target an 18%. We have projections that show higher than that, but we're very comfortable um, shooting for an 18% annual rate of return on your investment. And it's a 70-30 split on the equity side, meaning that every partner that comes in and our current partners, they would have 70% of the upside equity of each one of these manufactured home communities that we purchase. So all the upside, as you can see right here, they would have 70% of that equity upside from when we sell. And once we revitalize the community, we usually hit at least a minimum of a 2x multiplier on the market value once we stabilize the community. And kind of a little quickly what a stabilized community is. We consider a stabilized community anything above 90% occupancy with market rental rates. And it's something that I would be happy and safe to live in myself with my family. If I'm not happy or if I'm not comfortable and feel safe enough to move my family in, and we don't consider it stabilized. And again, we talked about this goodwill returns. We'll go into more of that here in a little bit. So here are a couple of questions that we get normally with what we do. Again, we invest in value add manufactured home parks, or how do we select the communities that we purchase? So that's kind of a loaded question. So there's a lot of different factors, and I'll sound like an attorney when I say it depends. So it depends on number one, the market. We have certain target markets that we selected based off numerous factors, including employment, which is a very big one. We prefer to have healthcare, education, government, and military to be the top producing job sectors in any market we go into. Obviously, a growing population and a larger MSA of 100,000 or more. So that way we feel very recession resistant, and that the job loss and whether the economy fluctuates, those jobs are always in demand and always employable. The other thing we look for is the size of the community. We've realized that when you go under 50 pads, that's kind of our minimum. When you go below that, it becomes a little bit harder to manage effectively because of your cost of operations. So we prefer to have a larger park around 80 to 200 pads as an anchor park, and then we will purchase communities and other parks around it as kind of a bolt on and where we can build a portfolio. Because the main goal and strategy we have with MH Estates Capital Partners is that we build a portfolio of 400 to 500 pads that are stabilized communities that we bring to the market. And the reason for that 400 mark is that we realize around 400, you have not only all the other larger operators and fund operators like myself, but then you also have institutional buyers who will then throw their hat in the ring. And we've seen in our past performance and other sales that I've done that they'll actually bid each other up and they'll actually compress the cap for a greater return. So we want that bidding war. We want them fighting over each other to purchase our assets. And we realize that 400 mark is really that's that kind of key point that everybody looks to hit for. What other financial benefits can investors expect? Well, because these are mobile home parks, we have accelerated appreciation. So our investors, we also cost seg every single park that we purchase. So our investors get the benefit of the accelerated depreciation across their investment term until we sell, as well as because we do a lot of value add, we have a lot of capital expenditures. So that includes anything on infrastructure, anything that increases the value of the property that's long term. So example, paving the roads, installing new utility lines, new service for electrical lines, light poles, those items that we can right use those expenses to cover our gains, and it really limits the tax liability for our investors. So they have not only depreciation, but also the expense, the CapEx that they can use to defer a lot of their gains. And how do I mitigate risk? So it's a good question. There's always risk in everything, but the reason why 12 years ago I sold everything I had and went in strictly into mobile home parks about 8 years ago, we started 8 years ago, sold everything we had, is because mobile home parks, whether things are going well in the economy or things are going bad, affordable housing is always needed. And so it's the most affordable housing that you can have, yet you don't have all the maintenance and all the operational expenses like you do with apartment buildings. We talked last time that apartments, the national average for turnover rate of apartment units is 47%. So that over half of your inventory, half of your units are being turned over each year. Well, mobile home parks, it's less than 10%. And the reason being is that the tenants that live there own their home. We want them to own their home. And when they own their home, it's less likely that they will leave because the lot rent's so low versus going to an apartment or buying a home. In fact, the national average, this is insane. National average of a mortgage for a home being purchased today in 2025 is $3,000 a month. Our lot rents are generally between $400 to $600 a month, vastly lower than an average mortgage of a U.S. house. And so when you have that low of a payment structure and a good quality of living and a good quality of life for tenants, the turnover rate's extremely low. And because of that, and because of the livelihood and the community aspect that we have and affordability that we have a rap sheet, arm length long all the time in every one of our communities of tenants pre-qualified, ready to move in at any moment's notice. So if you talk to a good operator in mobile home parks, you'll ask them, like, what do you do for marketing? If it's infill with new homes, obviously you do some marketing, but anything other than that, there is no marketing. We always have a wait list of tenants wanting to come in and buy whatever inventory is available. So again, to mitigate risk is number one is location. Location is everything, and management. We have a 12-year track record of managing these parks, and we've learned the hard way on our own dime the first 6 years of doing it, until we kind of worked our way up into larger levels. But we effectively looked for pain points in the industry, and so we became specialists at the pain points, the hard things that are to do in this industry. So filling out vacant pads, selling vacant homes, turning around dilapidated or mismanaged communities. And because of that, we're able to get financing. And so we became specialists at the hard things. So everything else is actually easier. So we can do like everyone else, but the gains are much better when you have that value add component going in.
Hey, Major, how are you, man?
Hey, John, how you doing? Thanks for
Good to
joining
see
us.
you. Sorry, I'm a little late.
That's all right. So we've got some questions. We'll do this at the end, guys. I want to get through this real quick and make sure we get it. Kind of an impact of our model and how it all works together and how it all conjoins. So partners initially do their initial investment, then we'll go and purchase the property, do renovations up front, because we realize that with the tenants as well, we discussed this last time, our partners' returns are the top of the model. That's the main goal. However, to get there, we have to create and give a community aspect, a livelihood for our tenants that so outperforms anything else they can afford or in their area, that our turnover is very low, and we can have high market rates or higher rental rates to get better returns. So our biggest thing up front is showing that we care and that we're putting our money where our mouth is. A lot of these operators will purchase communities, jack up the rents, and fix nothing. And that's where you see them on the news. They have issues, a lot of turnover. We don't do that. We go in up front, clean it out, put our money where our mouth is. So we'll do some of the structural CapEx developments up front to make the community better, cleaner, and have a better living standard. And by doing that, filling out vacant models or infilling vacant pads, we get a much higher clientele, a much better tenant that comes into the community. So we're setting ourselves up for better tenant retention, less tenant turnover, and higher market rates all up front. And if you can take a month or two to do that up front, it makes years of difference. We're able to increase a lot of our communities, their lot rents and rents to market rates that usually for a step-up schedule, like other operators, would take 2 to 3 years, and we're able to do this within a few months of closing. So obviously, once that's done, you have the revenue and expense decrease because we know how to operate more efficiently. We're vertically integrated, so we have 4 different subsidiaries that all work combined. So we have our acquisition fund, which we're talking about now, our management company that's been managing for over 12 years in mobile home parks. In fact, I cut my teeth with Section 8. Kind of tells you a lot. We have our dealership as well that can sell and purchase manufactured homes in any state that we operate in, and then our finance company that will help finance the homes to our tenants to get full cycle, and that allows us to be more efficient, move quicker, and more effectively turn this property around to make it as profitable as possible. And once that's done and stabilized, then we have the prosperity portion where we can refi out. So we'll purchase a property, we'll do our strategic planning on redevelopment up front, fill it in, get the occupancy to where we see fit around 90%, and we're able to refi and cash out our initial investment for both us and our partners to get their investment back. If they choose to, they can roll it into another fund or leave it in, but get their money back in a very short term, which allows the property value to vastly increase, returns to be better, and then everybody has their initial investment back that they can then use how they see fit at that time. So real quick, a few things that we're looking at right now, just kind of give you an idea. We're actually closing on this one this month. I found a 133 pad portfolio in Columbia, South Carolina, where we already have 6 other parks in that region. Love that region. It's outstanding, huge demand in that area. And why, and as we talked earlier, why we like the Columbia area is you have the University of South Carolina, you have Anthem Blue Cross Blue Shield, Health Keepers, their main building and main operation center is there in Columbia. You have Fort Jackson, the largest military training base in the United States there, as well as a large production of Volvo, BMW, and many other manufacturers in the area. So it's a perfect area, perfect niche. It's got an MSA of 800,000 people. The demand is huge. It's a great market, highly underestimated. We love it. We've been investing in there for over 8 years now, and over after this, we will have over 11 communities that we've owned in and around the Columbia area. But 133 pads, we're on a $6 million purchase. The rents are currently about 35% below market value. And I estimate that we will, within 24 months, be able to bring these communities to an over $9 million value, giving almost a 2x or 3x of our initial capital return. Another one we're looking at is in Whistle Stop, Texas. Why Texas? The four states that we like a lot to invest in is North Carolina, South Carolina, Florida, and Texas. They're just very landlord friendly, red states. The stereotype and culture is very pro mobile home parks, and the demand for affordable housing is just, I mean, it's anywhere you look, but we particularly like those four states and have experience with those four states. Again, this is another value add. It's 38 pads currently. There's about 130 acres that we can develop another 115 pads if we should wish. You can also, other options, you could rezone that land and sell it or partition it out. So it really gives us an ability to play around with it. It's off market sale, and we're negotiating right now. And I think we're going to get it under contract around 1.5, 1.6 area, which would be a huge win for us because again, we can turn that community around within 2 years. And as we stated earlier, kind of a quick breakdown. We shoot for 18% annual return for our investors with a 9% pref, 70-30 split, 70% to the investors, 30 to us. On the equity split, investors always get paid first, no matter what. Even if it comes out of our split, it doesn't matter. And we have a 24-month goal of return of capital, and that's why we have our stabilization period within 24 months. And you can look at our track record. We usually hit well below or before 24 months, but the goal is 24 months for a return of capital. So real quick, next steps. I'm very proud of this. This is really cool. This is a QR code to access my AI clone. So if you like talking to me so much, you want to talk to me at like 3 o'clock in the morning, go to this thing and you can talk directly to me. It'll use my voice, has all the answers that I would give you normally. We're updating it, so please play with it, look at it. It's going to give you the same answers I would give. You can also use this link here to schedule a call with me, a one-on-one call, 30-minute, 45-minute call that we can go over your investment goals, what you're interested in, any questions that you may have on our current offerings, and just overall just questions about the marketplace and mobile home parks, period, because we know it's a not very well-known asset. There's a lot of questions, not a lot of materials out there to understand what it is. So we're happy to answer those questions. With you guys being today, if you're watching, please subscribe. We have a YouTube channel. Subscribe to that channel and sign up for email on our website that you can go to. And I forgot to put it on here. It's mhestatecapitalpartners.com. I'll do that on the next one. You can sign up, get access to a deal room, see all of our documents, get access to these weekly webinars that we'll be doing every Tuesday and Thursday. And then finally, if you're ready to go, we'd love to talk to you about your initial investment. We look for a minimum for accredited investors with a minimum investment of $50,000. And yeah, we've had a lot of outreach and we're growing quickly. With that acquisition this month, we will have 6 parks under our portfolio and a little over 300 pads that we've had, and we started in October. So within 6 months, we went from initial offering to 6 parks, over 300 pads in a small target segment. So we're 1 or 2 parks away from finishing out that Columbia portfolio, and we're very comfortable. We'll do it later this year. So Please go ahead and ask away questions. And if after that, I'll go to the chat and I'll read off the questions there. So go ahead, William. I know you got some questions.
What kind of minimum time are you looking to invest?
Yeah, that's a great question. So it's a 5 to 6 year commitment, but we do a 24-month, as we stated earlier, 24-month return of capital. So there's a reason for this. And Larry can jump in on this in a little bit, but there are tax benefits that you can use because it's a 7 year term, but we shoot for 5. There's tax benefits for that, but also it allows us enough time to satisfy and stabilize each community that we have to get the maximum amount of the market value when we sell these parks. But to answer your question, it's a 5 to 6 year term, but we are looking to get, and our goal is to get your capital back to you within 24 months, if not sooner. And if you look at our track record, this previous sales that we've had, other parks that I've owned, you can definitely see that the track record's there. And I'll be happy to run the numbers through you if you want on a call.
Okay, and your minimum investment?
Yeah, so minimum is 50,000. There is a credit investor, and I know Larry can talk about that too, but there's certain parameters. I think you have to make more than 200,000 a year or have $1 million net worth, and you're considered a accredited investor. What you do is after this call, or you can go on our website, log in, sign your information, you'll get access to our deal room. So you'll see all of our current communities that we own, how they're operating, and you can also see our offering memorandum, and as well as a subscription agreement, which very plainly states, here's what you're looking at, and it's the same terms as stated earlier. Once you have that, we would set up a call with you, and you're welcome to go ahead and make your investment then. A wire is probably the easiest, but yeah, that's kind of the nuts and bolts of it.
Okay, and you offer the option of just sticking with you long term, y'all doing the legwork, we're just strictly passive income, and or at some point we could branch off and y'all would kind of help us out on that end.
Exactly, definitely. So right now we're not looking to get a huge, we don't want you to be a number on a spreadsheet. Okay. We want a consortium of investors that we really like and enjoy, and especially with this first fund, that we can continue to roll into future funds. That's our hope, that you enjoy working with us so much, you're so happy with your returns, that you roll your investment over into the next one. Because again, the way these parks are, during COVID, when people were struggling to get payments, our properties doubled in value. The demand for our homes is greater than it's ever been. And I've been doing this for 12 years. And so we're very confident that anyone like yourself or whoever else were to invest, especially with us, would see that the demand and the affordability and the management it vastly beats any other asset class. And as far as rental real estate goes, so as multifamily residential, hands down, it's not even close as far as a minimum of risk and return and the amount of effort that's involved in it. It's just not mainstream because it's not considered sexy, but we are seeing that kind of tide turn. A lot of people are now considering manufactured homes as a first home option because it's a third, if not a fourth, of what a normal house is selling for in their market. So that stigma is really going away, and let's become very pro manufactured home communities.
Next question, if I may, in Florida, we got an issue with insurance, and you mentioned y'all were doing some self-insurance.
Yeah,
to solve that problem.
Yeah, so we're working on that, and that's for a different model that's coming in the future. We do have other avenues and resources that most people can't get for insurance because we're a larger operator and we have a large amount of pads. We have access to other insurance initiatives and captives that we can use to insure homes. But yes, we do require insurance on the homes that we sell. And yeah, in Florida, here's the thing with Florida, just like with these condos, right? You see what's going on with the condos, HOA. There's a vacuum. So there's so much market and so much money to be made. There's insurance companies that are come in. It's not going to just be gone all the time because there's such a huge demand for it. They're changing regulations. So it's really a state by state thing. So Texas and South Carolina is definitely different when it comes to insurance, but there's options there. You've just got to have the ability to get in. And because we're a larger operator with a lot of pads and parks under our belt, we can get those discounted deals and discounted rates just because it's a volume-based business when it comes to insurance.
Okay.
John, did you have any questions? I know you see you on mute.
I think the other thing, Major, to mention is, in our due diligence process, we try to stay away from flood zones and the grading of the property. So we generally never have had any real incidences of major damage to our parks as a result of flooding or weather events or things of that nature. In fact, when the two hurricanes came up through, I think we had some trees down. That was about it. But nothing else. So we don't like to buy in flat land, flood zones, and things of that nature. So we're very, very careful with that in terms of when we look at parks and acquisition. So we've really never had any significant claims for anything whatsoever in that regards.
Yeah, in the 12 years I've been doing this, I've only ever had 4 claims, 2 of them that went more than $5,000. And that's over the thousands of pads that we've owned and managed. In fact, to kind of give you a test to how these homes are built, we have a park that's in Jacksonville, North Carolina. And when the hurricanes came, I don't remember the name of it, but about 8 years ago, when it came through, it dumped 36 inches of rain in like less than 12 hours. It's like record breaking, 100-year storm. And only 2 homes had any issues just because the roofs weren't sealed properly by the tenants that owned them. And the wind, so this past year within Florida, especially as you know this, William, the highest rated wind gust was found around Tampa Bay, or I think it was Sarasota, and it was 119 miles an hour, right? And so there's a couple of homes that had issues, but these homes are rated for 125 miles an hour or greater. And they can actually go greater based on the wind zone that you buy them, because these manufacturers, HUD has stipulations on how they're manufactured based on where they're going geographically based on the climate. So Florida and more coastal areas have what's called a wind zone 2, which those homes are rated for 135, 140 miles an hour, which I think the highest land record ever is around 138 miles an hour. And they also have to set them up with additional straps, augers, mounds, columns to make them more fit. So after all the hurricanes that we've been through, we've never had a home rip open or flip over. The only ever damage that we've ever had was come from an actual fallen tree. Like with most stick-built houses, a lot of them aren't really affected until a tree comes on it, and that's just something we obviously do our best to do a lot of trimming and tree work and make sure we stay on top of that to mitigate that risk. But as far as the homes themselves, we've never had less than 4 out of a few hundred or 1,000 that we've ever had an issue with.
But one of the other things I like to mention, Will and John, is, and by the way, I'm Major's partner, and been a CPA for a long time.
Oh crap! I didn't show any slides.
No, there's no slides. So, we're getting there.
My bad.
And so I've been doing this for over 40 years. Invested in a lot of real estate over my years. But when we look at a deal to acquire, one of the things that's really important is that you underwrite that deal based on as is. Okay, we look at the cash flows. We drill this stuff down pretty hard. But the other thing, I'm old enough to have lived through a number of economic cycles in our country. Will, I don't know how old you are, but probably older than you. And one of the things that I'm a real stickler on is we like to do fixed rate loans. We stay away from variable. And I think a lot of people are going to get in trouble again on this cycle, mainly because they got stuck with variable rate loans in the past. And now what we've seen is they acquired multifamily properties or other types of properties, 4 or 5 years ago with low interest rates during COVID and other times where you're looking at 2% and 3% loans, and now they're gonna adjust to 7% loans, 6.5 to 7% loans, and they're basically there goes your distributions. I mean, there goes your passive income. So you got to be one of the big risks that you have to really pay attention to in our economy and the way we're set up ever since, we got taken off the gold standard way long ago. And this is what causes a lot of swings in the interest rates because the Fed kind of manipulates this and does this. So we have these big in and out tides of wealth transfer. And we like to be in a position where we capitalize on that wealth transfer. And we feel we're really on the cusp of that right now again. I think there's going to be another big wealth transfer in the next 2 or 3 years, if not just the next 2 years in this country. And it's set up for it. It was set up for it in 2008, COVID, even back in the savings and loan crisis in the 89, 90. So we go in, we when we acquire our deals, we do a very extensive pro forma, very conservative pro forma, but we always get fixed rate debt. And that way we know what our debt service is. We know what our cash flows are. We're not banking, we're not taking the risk of the future of what interest rates are going to do or inflation is going to do and that sort of thing. So we know what and if our numbers don't work and we don't acquire the deal, we don't acquire the deal. Let somebody else take that risk. We'll buy it at a discount down the road when they lose it. But I think that's a very important aspect today's economy and markets when you're looking at buying real estate because it's a large factor. We also, of course, nowadays you don't see 90 or 95% LTVs. You're seeing more 65, 70% at most, maybe 75% if you've been around a while and have a lot of track record. But that also keeps a lot of equity in the deal for that cushion also. So,
All right, I'm going to share this slide real quick. See how it works. I totally screwed up on that. My bad, guys. So, you can see it here, though. You've got
still not seeing it though.
to the AI. You see it? You still don't see it?
Says you started screen sharing. Double click to enter full screen mode. I don't know.
Yeah, I've got to fix it. There's something wrong with it. It's not letting me do it all at once. So, but yeah, hey, second one, man. I got at least one. I got one thing wrong last time. I got 2 things wrong. Next time I should get it. So that's how it goes.
Is it Larry or Lawrence?
You can call me Larry. My formal name's Lawrence, but I go by Larry. So
Okay. And you're CPA by trade.
I am been a CPA for over 40 years plus. Had a very big started out with the big four PwC in Washington DC. Left them up for partner and started a big firm in DC area. And that kind of grew and merged with a big national firm, and they kicked partners out at 60 years old. But I've been Majors and Bonnie CPA for quite a while, long time. I've actually invested with them over the years and done quite well. But I invested in every type of real estate you can think of over the years. Okay. And I really like this space. I got real bullish on affordable housing years ago. One of my first early investments was Boxable, if you've heard of them. They're out of Las Vegas, Nevada. They develop manufactured homes, but more on a smaller scale. But they're very modular. They're very modular in terms of how you can build them, and they got. I think they just reserved their name on NASDAQ. I was in their first offering about 3 years ago, and my stock has gone up 11-fold right now. It's just amazing. But I've also invested in other affordable housing investments. But I really liked what Major was doing, mainly because I found he's probably one of the best, if not the one of the best operators in buying value added. And I like the value added because I like the aspect of going into these manufactured home communities. And as I call it, we we buy a mobile home park and turn it into a manufactured home community. Really, that's what it is.
Right.
And I mean, the before and after is amazing. So you really feel like you're really contributing to this sector by making it a more desirable sector because of the stigma with mobile home parks. So when we go in and we start, you know, we our first 2 years we go in and we have a revitalization development plan to do that. Um, and then we're also raising rents. We're getting economies of scales on expenses, really increasing cash flow and making it a very desirable community. So within 24 months, we look to refi out our acquisition debt. Generally, we've been able to refi out our initial capital in most cases. So we're we can then take that capital and go employ it into another acquisition. And then within 24 to 36 months after that, we'll just keep improving the property, raising rents, increasing occupancy. And as Major was talking about, we use a market cluster approach where we try to achieve about 400 to 500 pads in a given market, and then offer that to institutional buyers. And
Right.
these institutional buyers, they're buying a much less riskier cash flow because it's a very stabilized, beautiful property. That's what they want. That's what they're looking for. And so the bidding war starts and they compress the cap rate and we're able to get a much bigger return on our investment, but as opposed to selling them individually to smaller buyers or other buyers. So right now that's what we're doing with a group of parks right now, and they should close with one. Well, some are closing this month, some will close next month, um, but Major really has has perfected the talent in this sector, I believe, and I've seen with respect to this ability to take these parks and really turn them in and turn them over that way. And so we've done real well with that. And we also buy some parks that are, I would say, more what we refer to as lighter turns as opposed to heavy turns. That are less initial capital intensive up front. And we kind of mix our portfolio that way just from a risk standpoint. But the heavy turns are higher risk, higher return. But so far they've been real well. I mean, we've done real well with them. So
Well, thanks, Larry. John, real quick before we go, I know you guys got other things to do. We've scheduled 45 minutes. John, did you have some questions or anything you want to talk about?
Oh yeah, sorry, I had a important call I had to take, but
All right.
so I missed some of it. But so Larry or Lawrence, how long have you been investing with Major?
about 10 years.
Oh wow, yeah, that's awesome. And you said that your
Mhm.
values have gone up like 10 times. I don't know. I missed what you were talking
Well,
about.
I mean, you'll see in our offering documents, we have a whole section in there on past performance, but we've had internal rate of returns, I mean, up in the 60-70% range, which are kind of almost, it's great. I mean, we love them, but
Yeah,
it's almost embarrassing to put in there in a way because, I mean, you almost don't want to put them in there because people might want to expect that. And
yeah,
we always have to say past performance is not indicative of future performance and all those stuff because the lawyer,
yeah.
legalese. But um, I mean,
Yeah,
it,
you don't want it to be too good to be true too. We're not
yeah.
a we're
Oh, absolutely.
we're not selling sham wows here. We want to show people realistically. But
Well,
yeah, the numbers are pretty insane.
yeah, the big driver on that is when you look at the IRR formula, right? I mean, it's you invest cash today and then you're discounting cash back to today from when you get it, right? So the big driver in that IRR is the fact that if we've been fairly successful in those refinances within 24 months. So if you're going to get all your money back, or pretty much close thereof within 24 months, I mean, that's driving your IRR. Okay. And then if we sell, and then there's some cash flow after that period. So there's passive cash flow, operating cash flow that's coming out. So that's coming back. And then the sale generates an additional return, pretty good return. So when you're looking at a 5 or 6, 7 year horizon, hopefully 5 in our case is what we like to do. And you're looking at that amount of cash coming back within 5 years within those increments, it's going to drive a nice R, as opposed to where you see most people, most fund operators and others, they'll buy a more stabilized property day one. Okay. And then you're getting small increments of passive cash flow for maybe 6, 7, 8, up to 10 years before they do a sale. So it's pushing the big bump, the big dollar return of your capital way out there. So when you discount it back, maybe their IRRs, they kind of tout 14%, 13%, 15%. Okay. But you're also banking on inflation, you're banking on interest rates. I mean, anytime you go with a longer time horizon, you got more risk. Okay, because in today's economies, I mean, most cycles are 7 years. So you got to play this cycle somewhere in there within that 10-year cycle and manage that. Where if you compress the cycle within there, then you have much more predictability and less uncertainty. But that's the difference between, how what distinguishes us out there, um, as a fund manager and operator and everything we do. And as also as Major said, the other thing I like is, I'm an investor in the other verticals, is we have the dealership, so we can infill on properties very quickly, and move new homes in there very quickly. And we also have the financing arm. So we can finance either through rent to owns or conventional financing for homeowners.
And I have a couple. So do those verticals affect the return, or are they just sort of subsidiary businesses that you're operating?
Yeah, they're affiliates
Just
of
affiliates, yeah.
yeah.
They're affiliates, but because of how we have them integrated and it's under
Yeah.
one roof, it definitely affects the return because we do it much quicker and much more affordable.
Now
Right.
we are going to go out with another offering soon on our financing company to raise probably up to 30 million on that, because we're scaling up fairly quickly, and we want to keep everything in house relative to when we infill homes on our properties. So we're gonna, since we're scaling up fairly good, we're probably gonna need a little more capital in our financing company. So we're gonna be doing a preferred stock offering on that company. Probably about a 9% coupon on that as a preferred dividend. And the nice thing about that is because, with a preferred dividend on that type of company, you get the qualified dividend tax treatment.
What did you call it?
Well, if it's a qualified dividend, it comes out of the company. You, instead of an ordinary dividend tax at your ordinary tax rate, it's a qualified dividend, and it gets taxed at your capital gains rate.
Oh, wow. Very cool. Yeah, I'd be interested in the debt funds. That's primarily what I'm looking for right now. I've got well, I have a property under contract that'll close here in a little bit, but once I have that capital, I'll have money to throw around, and that's what I'm looking for right now, is to replace my income so I can then spend more time doing these types of things. So
Sure.
the income fund's more interesting to me at the moment, but I do like the equity play. I haven't decided to come around, and that'll be my second phase of what I'm working on right now.
Okay.
Oh,
What's
Yeah.
that picture in your background, by the way? I'm trying to figure out
That's
where I
Kensington. Yeah, that's in
Yeah,
Kensington,
okay.
which is
I
a
was
subdivision
trying to figure out
in England,
where I
yeah.
saw, where I've been there, or seen.
Yeah, yeah.
Yeah.
Yeah, I went to go visit my uncle there when he was alive, and he had a property in this neighborhood. We were walking around. It was like, I want to say September, and August, September, and they not used to having 100-degree weather, and
Right.
there was no AC. and every place you went was just boiling hot. And but yeah, I was in Kensington right there.
Yeah, sure. Okay, great.
Yeah.
Awesome,
But-
guys. Thanks for being on today. Again, we'll do this again. I think next week we're skipping because we have the big MHI Expo and have another conference, but the second week of May we'll be doing everything every week throughout. So every Tuesday and Thursday we'll be having these webinars. Actually it's a podcast essentially, but we're doing a video version of it. But yeah, we'll be doing this every week. Love to have you guys join us and learn more. And again, we'll send out an email, but you'll see the QR code for the AI, and then schedule a call with me through our link, and let's link up. But other than that, appreciate you guys being here today, and we'll get on the next one.
Yeah, I'll look for that invite because I have a guy that was a long-term client of mine, and I think I must have sold him a couple $1 million in property, and he went from that into the mobile home business, so he's already there. But he'd be a good person to invite if he's available.
Great.
I'll try to
Yeah,
get
let's
him on
do
for
that.
next call.
Yeah, feel
Yeah.
free to send an invite to anybody you think that would be interested.
Cool.
We welcome it.
Sounds good. Yeah,
Thanks,
thanks very
guys.
much. I appreciate the information. We'll be in
Okay.
touch.
I appreciate
We'll
it.
see you
Thank you
guys.
guys.
Take care.
Take care.
Yeah, you have a good one, Major.
I see
Bye-bye.
you.